Hi, everyone, and welcome to the Distribution Strategy Group Best Practice Study called The Four Pillars of Profit Improvement, it says featuring, it should say starring Dr. Al Bates. He's the superstar of distributor profitability. We're delighted to have him on the program today. My name is Ian Heller. I'm with Distribution Strategy Group. And so before we jump into the program, we're going to do just a little business so we can pay the bills. But these are some great tools that we're going to talk about for everyone in the audience. First of all, we've developed a new tool. I say we, it's my business partner, Jonathan, who's the genius PhD in computer science, called Demand RX. And it helps you estimate end market demand. If you want to do coaching with your salespeople around wallet share gaps, or if you want to size sales territories or figure out where to invest in inventory or branches, or just understand wallet share or market share, you got to look into Demand RX. It's a phenomenal program, and I'm so proud to be associated with it. All I can say is if you're ever going to go into business with someone, my recommendation is you choose a genius. So you can reach Jonathan at jbein, that's JBEIN, at distributionstrategy.com. This is a relatively low cost and really phenomenal way of understanding end market demand by account, by zip code, by customer type, you name it. It's wonderful. Okay, so secondly, if you aren't signed up for our upcoming conference, Applied AI for Distributors, make sure you do that soon. We're expecting about 350 people. We already have 65 signed up, which is way ahead of where we anticipated for a sellout. We're bringing back Zach Cass, who was the highest rated speaker I've ever seen at a conference last year. He had a 4.9 out of 5. He used to be the head of go-to-market for Open AI, and he's still a futurist, and he's a phenomenal speaker. So we're bringing him back. We have a really interesting agenda. There's one section called "What Investors Expect from Distribution Companies," and Ryan Merkel from William Blair, who's an analyst that covers, Grainger and Global and Fastenal and Watsco, you name it, all the big public distributors. He's going to be on that panel. Super bright guy. We got a bunch of other speakers we're announcing soon, including one for a session called Cybersecurity in the Age of AI, which is really important for anybody, but distributors particularly, because we have some certain vulnerabilities that other businesses don't. You're really not going to want to miss this. It's June 4th through 6th at the Chicago Marriott O'Hare, where it was last year. We're going to have some fantastic technology companies there explaining how they use AI in ways that you can use AI. You don't want to miss it. It's going to be fantastic. Okay, now it's time to bring in Mr. Mitch Lee from Vendavo. Mitch, welcome so much to this program. Thank you for supporting this important work, and I will turn the stage over to you, my friend.
Ian, glad to be here. So, you know how they say break the ice with a joke? So,
Yes.
when does an ordinary joke become a dad joke?
I don't know.
It
What?
becomes apparent. So,
Oh my
I'm
God, I
Mitch
love
Lee.
that.
You can use that. That's
I
fine.
will.
That's out in the public domain. I am Mitch Lee. I'm the profit evangelist for Vendavo. We're terribly excited to sponsor this webinar on profit improvement because improving profitability is how we help our customers. And here's the thing, selling is hard. Selling profitably is even harder, and distributors know that better than anyone else. You have to manage a very thin margin between the cost from your suppliers and the prices to your customers. Sometimes it even comes down to getting the most out of every incentive dollar on the table, on your buy side and your sell side. So on the next slide, what does that mean? Well, profitable selling means profitable wins. Your sellers need to offer the right product at the right price with the right promotion to the right customer at the right time. On the next slide, we see what that means in terms of success. In the case of this Fortune 500 distributor, payback was in the order of the first quarter of use.
Wow.
The next slide. That's why Vendavo focuses on flexible solutions for pricing, quoting, and rebate management. Some of the most successful distributors in the world you can see listed here. And finally, on the last slide, if you'd like to unlock top line growth plus your bottom line profits for your business, you can learn more on the distribution pages of the Vendavo website listed here, or reach out to me directly. We can even swap dad jokes. So how do you know when a dad joke is finished?
How?
When it's full grown.
like the full grown, that kind of grown. Oh my
That's the
gosh.
one.
Okay,
Thanks again.
so
Appreciate that.
Mitch, thank you so much. Mitch's email address is mdlee@vendavo.com. mdlee@vendavo.com. I had a good opportunity to attend one of their conferences probably a year and a half ago, and it was very impressive. Vendavo's got great tools for distributors. Now, let me bring in one of our regular guests and sponsors, Sandy Leon from Epicor. Sandy, how are you today?
I am good. And we're happy to be a sponsor today on this webinar. Next slide. So Epicor is really here for the hardworking businesses that make, move, and sell. When it comes to the move part, our distribution industry, we've been in it for over 50 years. We know your world, we understand your challenges, and we can help you solve them. In fact, when we ask new customers why they chose Epicor, the thing we hear most often is that we get them, and our software is the best fit for what they do right out of the box. In fact, I just heard that yesterday. We signed a new customer in Canada, and that's exactly what they said. So our ERP solutions, next slide, were and still are developed with distributors at the table to fit your unique distribution needs. It's really what sets us apart from other ERP providers. There are 5 decades of experience built into our solutions, and if you're growing, we've got the ERP that's going to support your growth. Our distribution customers tell us that with Epicor, Profit 21, or Eclipse, the growing part becomes easy. And with that, I'll turn it over. Oh, I have one other thing I was going to mention. A
Oh, go
recent
ahead. I'm
third
sorry.
parties, yep, a recent third-party study which came out, which you can find on our website, shows some really impressive statistics on how companies have benefited with our ERPs, and they're showing on this slide. But if you're looking for new technology that's going to allow you to grow and become more profitable, we'd love to chat. Feel free to reach out to me or visit our website. And
Hey,
Ian,
Sandy, real quick. I just wrote a white paper for you guys. It's going to be coming out soon on, a lot of distributors have what's called an S&OP or sales and operations process, but I add M to it to do SMOT process for marketing.
mhm.
And I mean, the ERP is really the heart of everything that's necessary to run a great SMOT process. And, I think these are phenomenal results that you have displayed here, but with a good SMOT process, you can probably accelerate all of it.
Even better. Love that.
Yeah. All right, Sandy, thanks so much. It's great
All
to
right,
see you
thank you.
again. You bet. All right. Let's bring in the star of the show, shall we? Dr. Al Bates is a legend. I know you probably hate it when I talk like this, but you are a legend, Al. And I'm so pleased and grateful that you're doing this program for us. Thank you very much.
Glad to be with you once again. Talk about the 4 pillars of profit improvement, and we're in an interesting situation in distribution right now. Profits are at an all-time high. Oh, but I still think they could be better, or at least can we maintain what we've got? So I'd like to start the program by looking at how come we've gotten to this great profit level. And if you look at this slide, it's got the impact of inflation, and I chose 10%, which is what we had a lot of times on profitability. This is a specific industry based upon their benchmarking survey, and I can't tell you what industry, but it's one of the big industries in distribution. And if you look at the first column, $20 million companies got a gross margin somewhere around 25%. And then their payroll is about 2/3 of their overall expenses, which is true in every industry in distribution. And you net it all out, take the gross margin, subtract the expenses, payroll and fringes being 2/3, all other being rent, utilities, depreciation, interest, bad debts, all those. I make about 600,000 or 3% of the bottom line, which is not bad. What has happened in the second column is with 10% inflation, sales are up 10%, cost of goods are up 10%, and gross margins up 10%. This assumes that we're passing along the price increases, which we've tended to do. And then the real key here is that payroll stay where it is. And what the situation is payroll is not going to stay where it is, but there's a lag, and it's a serious lag. The inflation came first, the payroll increases come second or third or fourth. And so when payroll stays constant, we get a real dramatic kicker in terms of profitability. Now, I must admit one thing right here. I cheated slightly on this exhibit. Don't shoot me on this. I ignored the commissions. So I kept the payroll right where it is, which is true for the hourly employees, the salary employees. Commissions would go up a little bit, but not enough to dramatically change it. And it makes it simple. If we look at commissions, we could spend 3 hours calculating commissions, and I'd like to just look at the concept. Other expenses up right along with normal inflation, about 3%. And in the bottom line, $1,058,000. That's a 76% increase in profitability. It's a giant increase. And this has happened in almost every industry in distribution over the last year or so. And if I look down at the bottom percent of sales, my 3% bottom line went to 4.8.
Wow.
That is a dramatic change. And I don't want to say that management doesn't deserve any credit, because certainly they continue to manage effectively. But I am going to say there was a bird's nest on the ground here that we were wise enough to pick up. My concern is, gee, now we're at the point where inflation is dying, and all these people who didn't get raises and didn't get additional benefits may want to catch up. And if they catch up, we could end up right back where we were. And I'd prefer not to go there. I'd prefer to stay at a higher profit level. Now, that's also true if we look at the next slide, that in every industry, the company has a 5% bottom line. And I think on the previous page, it was 4.8, but that's 5. There's always the high profit firms, and they're somewhere in the 8 to 10% range. Look at that number. I have never in my life, and I've been doing this for about 40 years, seen a year in which some companies got to 8 to 10% pre-tax. That is a phenomenal number. Now, in our normal year that we talked about previously, in which the industry is maybe at 3, the high profit were at 5. But now the typical's gone up to 5, and the high profit is 8 to 10. And what I'd like to do is say, can we make sure that we don't reverse this process and go back to a 3% industry? Can we hold on to 5? And can we, if we're really managing the business well, can we join that high profit group? Now, the high profit group is typically about 1/4 of all the companies in an industry. So we set those aside and say those are the really good ones. And my argument is always, gee, if 25% of the firms could do it, why couldn't everybody?
Right.
But the reality is it's not easy. Everybody's got a different market, different situation. But I'd like to see, can we drive towards that 8 to 10% level? Can we at least not go back to 3? To do that requires 4 actions, which I've got demonstrated on the next slide. And those actions I'm calling an improvement model, a rack suit plan. And a rack suit plan says, I'm going to give you 4 things that you absolutely have to do. Okay, there's not any negotiation here. Absolutely have to do these, but the numbers I put on them are based upon my looking at financial benchmarking surveys in about 30 distribution industries and saying this seems to be the sorts of things that cause companies to become more profitable. Okay, again, every industry is different. So you can argue with my numbers all you like, no problem, but everybody has to have the rack suit numbers. You got to do these 4 things. And if you don't, I'll be internally mad at you here, which counts for nothing, but I'd still be internally mad at you. What are these 4 things? Number 1, increasing sales, including our inflation rate in our industry, increasing our sales by at least the overall inflation rate, that is the CPI, plus what I call a safety factor of, and I'm going to use 3%. So I'm going to say maybe 3%. And all it says is I need my sales to outpace inflation. If you are in an industry in which inflation in your product line is still going, that would be a slam dunk. If you're in inflation or an industry where maybe some items are beginning to deflate, which we see in some industries, that gets a little bit tougher. And the reason I've got this safety factor is I want our ability to control expenses be there all the time. And most of the non-payroll expenses, that's important, non-payroll expenses tend to go up right along with inflation. Landlords have rents that go up, utility bills go up, all sorts of things tend to track with inflation more or less. So I'd like us to do that. I'm going to argue that's an easy goal, although maybe the best term would be less difficult goal, but I think it's a crucial goal we have. Now, please note that's a minimum. There is no maximum, although I think maximums tend to get a little carried away, but let's say at least this rate. Number two, and this is the biggie, this is the most brutal item on this list by far. I want payroll to grow slower than sales. And the problem we have is if you look historically, and again, I spent hours on end looking at stupid benchmarking surveys till I am bloodshot here. Over time, sales and payroll have grown together. And if you go back and look 20 years ago at payroll as a percent of sales and look at it today, it's the same number. So I'm asking you to do something we haven't done for 20 or 30 years, have the sales grow faster than inflation, and I'd like it to grow 2% faster. And that's going to create what I call a sales to payroll wedge, a delta, a gap, all sorts of things. And I'd like sales to grow faster than payroll.
Hey, Al, quick question.
Sure.
I mean, there have been a whole bunch of automation tools that have come out over the last 20 years to, make, make account managers more efficient, to make salespeople more efficient. And basically none of it has, all of it, maybe even if those things have worked, distributors have found other ways of paying more anyway, right?
Yeah, and this drives me nuts because I'm with you. If I look at this laundry list of things we've done, and let me just give you a small vignette. I'm old enough to remember when we ran inventory systems with a Cardex inventory system.
Right.
Okay. And our younger people don't know what the heck we're talking about here. We used to keep inventory records on 3x5 cards.
Yep.
Okay. We've automated everything, but at the same token, every time we made an improvement, we seem to have given raises. We seem to have gone right along with sales. And also, we've added a lot of services. Many distributors are doing things they didn't do 20 years ago because of the competitive balance, and it's ended up narrowing out, Ian. And I'm with you. I'm just bothered that we've spent all this money and all this sophistication and become better managers, and we've not done anything in terms of payroll. So I'm going to do the next few pages to do something that's unnatural.
Yeah, it's crazy. It's great. I do want to tell the audience, if you have questions, please jump in, and I'll stop interrupting you, but I didn't want to get that in there.
Absolutely. Any questions anytime.
Yeah. Okay, keep going.
Number three, increase the gross margin percentage, not the gross margin dollars, the gross margin percentage by 1%. That means, for example, if I've got a 20% gross margin, 1/10 of that would be 20.2. Okay. Now, there's a big push in distribution among a lot of consultants to say the gross margin percentage doesn't matter. It's the gross margin dollars. Okay. Those people who say that are lying, egg-sucking dogs here. Okay. Again, I look at the data. In every industry in which there's a benchmarking survey, those high profit firms have a higher gross margin than the low margin or the typical firm. So the high profit firms, higher gross margin percentage than the typical firm. So I think we got to join the parade. I'm saying 1%. Again, it might be 2, it might be a half. It's a brack suit, but my experience is 1% is doable. So if I'm at 10% margin in a really low margin industry, go to 10.1, 20% go to 20.2, high margin 30% go to 30.3. It's doable. And then the last one is the easiest of all. Allow the other expenses, the non-payroll expenses, to float with inflation. Now, I don't say ignore them, but I'm going to come back to the old term benign neglect. Spend most of your effort elsewhere, make improvements in the non-payroll expenses where you can. And so make those changes, but don't focus heavily on that. Focus on payroll, which is 2/3 of expenses, and focus on gross margin. So I'd like to start with those first two items on the bullet point, sales and payroll, and talk about what that means and how we do it. And as you can see on this slide, it says controlling payroll without sacrificing employee enthusiasm. Well, maybe a little bit. Okay. I want to keep employees happy, so I want to give them raises. And I'm going to go back to my favorite baseball manager of all time, Casey Stengel. And Casey Stengel said the way to run a successful baseball club was keep the players who hate you away from the ones who are undecided. And so what we're going to do is we're going to say we want employees to be happy, to be satisfied, but I still got to have the sales grow faster than payroll. And I'm going to give you 3 alternatives. Number one, suppose sales grows by 5%. And let's say, for example, the inflation rate is 2, hypothetically. We add that 3-point safety factor. That says 5% is kind of our minimum level of sales growth. If we're going to have a 2% delta, I can only let payroll go up by 3%. That in today's market is blooming tight. Okay, no doubt about that. So maybe we say, all right, we'll get 10% sales growth. I can then be generous with my employees. I can maybe add a little infrastructure, have the payroll expenses go up by 8%, still a 2-point delta. And then finally, we hit a home run, 15% sales growth. We definitely have to add some more employees, so some infrastructure, 13% sales or payroll growth, 2-point delta. Now, here's the rub. The rub is I don't know what my sales are going to be next year. Okay, how much are they going to grow? I got some ideas. Okay, we're just about to end February, but I still got 10 months. I'm not sure what's going to happen. So what my recommendation always is be extremely conservative with your sales growth plan, and then work back 2 points against that. And if I can still do that and keep employees happy, I'm in great shape. Because what would bother me, and I'll give an exhibit of this in a couple of seconds, we plan for 15% sales growth. We have payroll go up 13%. Sales growth actually comes in at 10%, which is, again, a nice growth number, but we've overspent on payroll. So first kind of general guideline is plan for conservative sales growth. Try to plan payroll against that conservative sales growth. And if we hit a home run, pay bonuses. Okay, it's nothing illegal about paying bonuses there for good performance, but I would like not to overcommit on the payroll side first pop out of the box. So that's my number one goal. And the question is, so what? What does that do for us? What's involved there? And if I go to the next slide, I want to look at what if we grew by 5%? Okay, I'm taking that minimum number. Okay, that's the absolute minimum, because I'm saying inflation plus 3, 2 plus 3 is brilliantly 5. And I'm going to have my cost of goods and gross margin go right along with it. So we're going to do everything growing at the same time. And then I'm controlling payroll and fringes where they only grow by 3. And again, I've got to admit right up front, that is difficult to do in today's environment. It's simply a what if example that goes on in distribution out there in the world. If I do that, and I make the assumption my other expenses, my non-payroll, kind of float with sales, they go up 5% right along with sales, which is not a bad assumption. My total expenses only go up by 3.5%, and my bottom line goes from $1 million to $1,110,000. Okay, that's a nice change. That's 11% delta in terms of profit growth. And so my 5% bottom line is 5.3 simply from this one factor, and that is controlling payroll against the sales growth that we have. Okay, this is what I would like to do every year, but this is what we have not done every year for only 25 or 30 years here. So, well, what gets in the way? What tends to happen? And what tends to happen is on the next exhibit. Before we go, okay, that's all right. Just remember, profit was now what? $1,110,000. You got to let your synapses fire and remember that $1,110,000. Now, the next exhibit says, well, what happens if we have that 2% delta, but it's a negative delta? So now what I've got is sales, cost of goods, gross margin up by 5, payroll and fringes up by 7. Okay, this could be that we planned for 10, only came in at 5. It could also be we open a new branch, expenses pop up before we have sales. We have to replace somebody in the field, a salesperson. That expense comes in their base salary faster than their sales come up. And notice here that with that, payroll and fringes go up 7%. Oh, that's terrible. All other expenses still up 5%, which is what we were kind of looking in the previous exhibit. Total expenses 4,200,000, and the profit, not the 1,110,000, the profit is $990,000. This leads me to a punchline, which I like to use all the time in presentations, and that is that sales volume by itself does not mean doodly friggin' squat. Okay, doodly friggin' squat is a technical term that I like to employ. Okay, what it says is it's not the sales. It's sales is important. I'm going to emphasize that, but it's how much payroll do you have to bite off to get those sales? Okay, and I've had all sorts of companies have 20-25% sales increases and profit goes down, okay, because of all the infrastructure I've had to add. So I'm looking, if I could, as my first two bullet points, sales and payroll balanced. Well, how am I going to do that? Man, how am I going to do that? And I have 2 points on my bullet point for that, but they're pretty anemic bullet points on the next slide here. And we've talked about these before, Ian, so we maybe just chat about them a second here. Fundamentally ordering order economics, okay? You know, you and I have talked that you've been pushing order economics. English is a second language for me. I've been pushing order economics and nothing's happened. Okay? Yeah. It's like a concept whose time has come and gone.
Yeah.
But my argument is it's a crucial way to improve profitability. And I just think about, I go to McDonald's, okay? And as soon as I order, the first pop out of the box is, would you like to biggie size that? And this is by a 16-year-old employee who's part-time, only working because they need some extra money and probably hates McDonald's. You know, they can make this work. We should be able to make this work. I think the concern is, and the challenge is, and maybe some of our sponsors of today's program could help us here, the changes I need are small, and they're maybe difficult to measure whether we're getting them or not. For example, if I got an industry where the average line extension is 4 items, if I could raise it to 4.1, which is like almost rounds to 0, that dramatically changes the profitability of that order. It's the same number of orders, same number of deliveries. There's just 1/10 of a line on every order. It is difficult, however, to measure that succinctly. And I think part of my problem is across the course of the year, I tell the salesperson, well, you're not getting it, you know, right. You're not putting enough lines on the order. Well, this one customer did something, or my market's changed. So 2 kind of problems there. It's awfully hard to measure precisely, and there's a lifetime supply of excuses. Okay. Having said that, I got a 16-year-old part-time employee who can do it every single time. 20-year veterans ought to be able to get with the program, I think. So I'm still pushing the concept of I'll push it for as long as I can until somebody actually does something here.
Well, I think it's behavior. It's also can be policy driven, right? So if you have free freight at a certain level and you can get people to round up to that level on a regular basis. I mean, you know, to me, the biggest part of order economics, Al, is average order size. If you because there are cost to serve and some other factors involved. But if you could start with just average order size and get people to pay attention to that and drive it up, then you can get a lot of the benefit of this.
Sure. No, average order size is the name of the game.
Yeah.
In my usual analytical style, I like to come back and look at the components. But you're right. If we just measure that one factor and just say, let's measure against that going forward, see where we are. Absolutely. Okay. So hopefully you and I can make some change here, but I'm still pessimistic. The second one, don't expand.
Oh, sorry. Okay, there we go.
The point is working with customers, and there's a lot going on in terms of customer profitability, as you know. The one thing I would caution against very quickly is I am not a firing customers guy. Right. There are lots of people in the world, consultants, who are firing customer guys. That's fine, but my concern is I fire a customer and next year they buy my biggest customer. I need to rehabilitate customers. And again, this is an issue of getting to buy less frequently, to buy more each time they do buy. it's a lot of work, and firing customers is not a lot of work. That's quick and easy, but I think long term, I can't fire my way to success, either the employees or customers. I need to spend a lot of time working on how customers buy one at a time. It's a big nut to do, but I think it's critical.
Yeah, and I'll tell you, Al, I totally agree. I think it's so hard to get a customer and to get them to keep buying. And I've scrambled so hard in my marketing career to hang on to them to prevent churn that when I hear people talk about firing them proactively, it just sounds so arrogant and so wrong to me. That I'm in your camp completely on that.
Thanks for saying that, because it's really trendy right now.
Yeah.
And it's a lot of trendy things. I think eventually it'll prove wrong. All right, so that takes care of the sales and payroll. The second big item is the gross margin. And I need to improve the gross margin in my particular business. And this particular exhibit says improving gross margin by either buying or pricing. So we're going to play let's make a deal. And let's make a deal. We got two doors. Door number one, buying it cheaper. Door number two, selling it higher. They're both good doors. Let's assume that we're going to throw caution to the wind, and we're going to take a 25% industry and we're going to drive it to 25.5. That's a heck of a lot more than I talked about doing before, but let's do it. Okay. What the heck? You're a great manager. Go do it here. So I'm going to get to 25.5%. If I go through the buying door, I'm going to keep the sales right where they are. Okay. Because we're doing it always buying. I'm going to buy it. It turns out to be $100,000 cheaper. That $100,000 then becomes gross margin, assuming that our sales force does not take it to the street, which is a big assumption we'll make. But we're going to not tell them we bought it cheaper. We're going to build a team by lying here. So I'm not going to take it to the street. That means the gross margin goes up with the entire $100,000. The payroll and fringes maybe go up just a little bit because I got more margin and I'm probably compensating my sales force based on margin, but it's incidental. The other expenses stay the same because we're not doing any more work, and the product becomes $1,094,000. That's fairly straightforward. The pricing side's a little bit more complicated, but I will give you the quick and dirty version. The cost of goods in the last column is going to stay $15 million. So we're not going to buy it cheaper right now. We're going to sell it higher. I'm going to raise my sales volume to 20,134,228. Now there's a number only a finance guy could love. Okay, it's incredibly ugly. I'm aware of that. But if I keep my cost of goods 15 million, it means my gross margin becomes 5 million change, and that turns out to be exactly, get ready to be impressed, 25.5%. But that's going out the outbound door rather than the inbound door. Payroll and fringes are going to go up a little bit more because I got even higher sales and higher gross margin. Other expenses still stay the same. Profit becomes $1,000,001. Here's the crucial factor. Buying it cheaper is nifty. Selling it higher is niftier. There is always, in every business, in every line of trade, there is a lot more profit impact from the outbound side than there is from the inbound side. That doesn't say we shouldn't worry about the outbound side. Doesn't say that at all. It says that we need to worry about the inbound side, but I got to worry about the outbound side. Most distributors I know of are so concerned about having pricing integrity with their customers that they are scared out of their mind about the outbound side. If we want to think about it mathematically, think about it this way. Sales is a bigger number than cost of goods. So improving the bigger number has a bigger impact than improving the smaller number. So it's true market-wise, it's true mathematically or whatever. I need to have a little bit more bass in my voice to be able to get that outbound side. So I want to look at what are the opportunities or what are the attack points with regard to a higher gross margin percentage. And they're on the next slide. And remember, we're still going to buy it cheaper.
Hey, Al, we do have a question from the audience.
Do we have a question? Great.
Yeah. So, and I mean, this is interesting. Any recommendations for how to successfully implement a minimum order policy? given all the reasons for why that makes us difficult to do business with. So are you for a minimum order policy? And if so, how would you do it?
Yeah, let me phrase it this way, Aaron. I'm in favor of leaving the 1970s. Okay. Uh, I I am amazed, absolutely amazed by the number of companies that still don't have a minimum order. And I'm saying, well, you're not just in the 20th century, you're in the 1970s of the 20th century.
Yeah.
Every firm that I know of that has led the industry, okay, let's take an industry in which nobody has a minimum order. Every firm that's led the industry in a minimum order has had 2 weeks of blowback. After that 2 weeks of blowback, all the competitors have also put in a minimum order and a follow the leader mode, and their profitability has gone way up. So I don't have a way to make it easier. I do have, though, just to say, explain it to your customers. Most customers understand why you have to have a minimum order. Most customers are not going to complain about that. They really aren't. They understand you as a distributor have to make a living. But if you just send out an email, we now have a minimum order, I think you got some problems, would explain it. And I think again, I'll say 2 weeks, all that problem goes away. Now, still, for my good customers, I got a $25 order. My salesperson's going to put it in the trunk of his car and deliver it for a great customer. But I'm still going to have minimum order integrity. Absolutely. That's a great question, though. But I'm a little bothered that we still have companies that don't have a minimum.
Excellent. All right. Thank you.
Okay. Great question. And I look forward to any of those you have. How are we going to improve this? Okay. What are the attack points? Okay. One is to ensure that when I do buy cheaper, it actually increases profit. We talked about this earlier. Okay. A lot of times I buy it cheaper and my sales force decides this is a great way to build relationship with customers, and we take it to the street. I'd like to eliminate that. Number two, a lot of times I say, gee, I bought it cheaper. Why don't I drive my competitors to their knees here? Well, let me tell you, you know what? They bought it cheaper also out here. So that's a problem. I also, if I've got a lousy system, a lousy computer system, I may put that lower price into my price matrix and target the same gross margin percentage on a lower price item and lower my price outbound. So to me, when you get a deal from a supplier, put that money in your pocket. Absolutely got to. Number two, raise prices systematically. And you and I have talked about this before. There's a fear about raising prices. And on A items, you can't raise prices. I'm aware of that. Those are commodities. In every industry, you can't raise prices, because if you raise prices on those items, you're telling your customers you're high on everything that you sell. Okay. You might as well go out on the interstate and put a billboard up that says we're high on everything. If you put that billboard up here in Colorado, where you and I live, you have multiple meanings to that statement. But if you try to raise prices on 10%, you're dead. At the other end, D items, probably half my blooming SKUs, probably no more than 5% of my sales, people buy those when they absolutely have to have them. And the absolutely brilliant value added you have is you got it when they need it. Okay. They're not going to say, well, gee, I think in 2 days I can get that from Amazon cheaper here. I need it right now. I've had customers raise D items 10%, 20%, 30%. At which point I begin to say, gee, that's really high. What do customers say? And they say, they say the same thing every time. Thank God you've got that.
Right.
So I've got to have the discipline on the D items. Let me tell you another little anecdote, since I'm in the war story business today. Had an industry that we looked at what was pricing on special orders. Okay. Now, special order is I don't have the item in stock. Nobody has it in stock. I got to go to my vendor. I got to find out what it is. I got to buy it, have it come in. I've got to treat it kind of an offline item, and I got to deliver it to you. what we found is on those special orders, the gross margin percentage achieved was actually lower than my overall gross margin.
Wow.
So I'm doing a heck of a lot more work for a lower gross margin percentage. And the reason is it's priced one item at a time. And on one item at a time, I'm afraid, oh my God, if we get our normal margin, they'll think we're screwing them here. This happens all the time. Number 3, control the sales force. I've already beat this to death. So I will say this, though, in giving homage to the sales force. Salesforce got the toughest job in the business. I got to understand everything about the business and deal with irate customers. But I need to continually work with them. Explanation. In my younger days, I was a fire them and get them out of here guy. But then we brought in the next guy who was just as bad. So now it's a work with them all the time. You cannot over-educate them about pricing. And then finally, capitalizing on supplier price increases. And we talked about that earlier in our very first exhibit. When you get a 5% price increase, raise your prices outbound 5%. Don't go soft on those price increases. All right.
Got a couple of questions here.
Sure.
The one, actually, they're both suggestions. Eric says he would add to this bulleted list minimizing discounting.
That to me is kind of the same as controlling the sales force.
Yeah.
Well, I don't know if there's the discounting on a more global level he's talking about.
Yeah, maybe the customer service people, if you don't consider them part of the sales force. But, and then Brian, getting back to our conversation about putting a minimum order in place, says, make sure you put together talking points for your sellers that, to help, I guess, probably coach them and train them on how to pass this message along about your new order, minimum order size,
Right.
and create bullets and training for the service team as well.
Absolutely. No, anytime you change policy, whatever it is, you need to explain that to the people who are buying. But again, I'm going to tell you my experience has been that's actually an easy sell.
Yeah.
If you explain it. Just tell them, hey, I can't make money on a $75 order. Sorry.
Right.
Right. All right. Let's talk about improvement. And these are coming back to my rack suit bullet points. I've got what I call the mandate for change. And I love that term. I stole that term from the United States Congress. And what it means is I'm going to tell you what to do, but then I'm going to leave. So you got to go do it here. So here's my mandate every year for 5 years. So I've got to lay out a 5-year plan. Number 1, sales growth 5%. Again, that's a minimum. Okay. So I'm going to look at what if we just do the minimum. Ideally 10%, 15 is great. What if we could raise that gross margin 0.2 of a point? Okay. What if we could control the sales to payroll gap 2 points? And what if the other expenses as percent of sales with benign neglect go down kind of a 0.1%? That generally tends to happen even with benign neglect because we find some ways to change. And then I've got inventory turnover and collection period, 0 change. And everybody watching is saying, finally, 2 goals we can actually reach down here. Okay. That does not mean don't let it get worse. Don't let the turnover go down. Don't let the collection period go up. But I'm focusing just on the income statement side right now, not the balance sheet side, which is another seminar entirely. What if we do that? What happens? Well, on our last slide, I've got what happens if we do that. And I got a lot of numbers for which I apologize. But 2023 is kind of where we are, starting again with a 5% bottom line. Already got that improvement that we got with inflation. We're not giving that back. We're going to hold the line on that. And so I got a 25% margin, payroll 15%, other expenses 5%, and we're going to have sales go up 5% a year. So next year they're going to go from 20 million to 21 million. That's 5%. And then in 2028, 5% compounded, I'm going to do $25.5 million. That's what happens to 5% sales growth every year. I'm going to take my margin from 25% to 25.2. And again, that's in that 1% range because 25% times 1% would be 2.5. I'm just going 2. That's doable if we do it bite-sized chunks. If I told everybody, gee, we're going to go from 25 to 26 this year, I get pushback. But 25 to 25 to, oh, that's realistic. That's doable. So my margin dollars go to 5.3 million. The payroll is going to go up by 3% a year to have that 2-point delta, but it's going to go down as a percent of sales. I'm not firing anybody. I'm not cutting anybody off at the knees. I'm giving everybody raises, but in this case, really puny ones, I admit. And payroll goes down as a percent of sales. Other expenses down slightly as a percent of sales from 5 to 4.9. And then next year, I'm at 5.6. Do that 5 years in a row, and I end up with a bottom line. Let's do the profit number first. I end up with $2 million of profit. I've doubled my profit in 5 years with what are some fairly small but challenging things to do, and my bottom line becomes 7.9%. I will remind you earlier that I said my goal for my bottom line was to be 8 to 10%. So my goal was 8. I brought it in at 7.9. Chronic underachiever. But 2 million's pretty good out there. I think that's a decent number that I could go to the bank with and enjoy. So I'd like people to do that if they could. Again, you got to put numbers on the 4 bullet points. I put some numbers here, but those are my numbers, arbitrary, but I think reasonably close as a starting point. You then got to take that starting point and say, what should we be doing in our business on those 4 bullet points? But you have to have those bullet points in your plan. You cannot say, well, we're just going to go to market. I got to have those bullet points in your financial and marketing plan. With that, any additional questions, Ian?
We do. We got a couple of questions.
Great.
Jeff, hi, Jeff. Great content on how to improve the financial performance. Any thoughts on specific tactics / initiatives to drive productivity gains in sales or operations that will enable the payroll wedge that you mentioned? That means we do more with the same labor level.
I think anything and everything I can do with regard to productivity is essential. I don't know if one's better than the other. Maybe AI, which you guys like to talk about a lot. If we bring that on board properly out here, we'll get some improvements. Anything we can do with the other operations of the business, but in all candor, Ian, we've done most of them. We've done everything that's low-hanging fruit out there. That's why I came back to that 2 points that were not productivity. They were order economics and working with customers to get them to be more profitable to us. I don't have anything in my bag of tricks with regard to productivity. I wish I did. But every time I look at them, I'm not getting an impact from it. Maybe it's improve the productivity and don't be so blooming generous on the outbound side with the raises out there. Make the productivity actually become productive. But let me hitchhike on that a second. When I look at these benchmarking surveys, again, going back 20 years or so, sales per employee has skyrocketed up. I mean, we are doing much more per employee. Okay, that's the way we measure productivity. But it's not going to the bottom line. It's not going to the payroll side. So I got to be a little bit more creative. I wish I had something else in my bag of tricks, but I just don't.
Yeah, I mean, I've always looked at it as like the minimum raise is going to be across the sales force, across the company, is the rate of inflation, right? So it's the cost of living adjustment.
That's where you got to be. And we've been under that, and we may have a bit of pay going forward.
Right. And the rate of sales growth is the upper band, and you want to come in somewhere in between there. What I've seen a lot, Al, is that people do these productivity initiatives, but they don't really hold themselves accountable for the productivity gains. So it's not so much that the technologies are wrong. It might be some kind of inbound order automation. It might be shifting sales to electronic channels, like e-procurement or the website. But they don't really have in place the mechanisms to assure that they yield the productivity gains that are in the proposal when they approve those programs. And so
Absolutely.
they kind of get forgotten.
That's a great point.
Yeah. And then we got a couple more. Let's see. Here's someone who wants to know, Al, are you seeing any positive trends in terms of rewarding salespeople based on profitable sales versus top line sales?
Short answer, no.
Okay.
I think the best I can do with salespeople is compensate them on gross margin, which we all do. Okay. When I begin to get to the compensating them on profitability, the sales force's eyes glass over. Okay. If they could do that, they'd be called accountants. Okay. They're called salespeople, and they've got incredible strengths in dealing with humans, in selling and handling with objections. They're not financial folks and never going to be financial folks. So I would stop at the gross margin line. And if you could get them to get better gross margin percentage, yes,
Yeah.
I would push that. But I would be really hesitant about trying to get them to go to a profit per customer, profit per order level. I think it's just more than they can deal with.
Yeah, I agree. And sales plans have to be very, very clear and simple.
Mhm.
And then Rhonda wants to know, how have you recommended getting pricing right for sales teams in the past? What resources have you used? In other words, what I think it means, what resources have you used to help the sales force get the pricing right?
Okay. This is a seminar unto itself, but let me do it real quick. And that is put in a sliding commission scale.
Mm,
That is really a sliding commission scale. Now, people have sliding commission scales, and the sales force cuts price, and the commission goes down $1.50. Okay, I'm talking about a commission scale that says when you cut price, you get a big hit. Okay, one thing salespeople understand is how big was my paycheck last month.
right.
So I'm a carrot and stick guy, but I gotta have the stick. I really do. They will understand and respond to changes in commission structure faster than anything else. And so that's kind of where I put most of my effort out there, is on a sliding commission scale.
Great. She says, great answer. So thanks very much. All right. If I could get the crowd to hang on for just one more minute, I want to tell you about a couple of upcoming programs we're doing. So on March 6th, we have a technology leader panel. So we have experts from technology companies work with lots and lots of distributors who are going to talk about how tech can elevate the customer experience and personalization. These are really phenomenal companies that have a lot to say about how you can improve customer experience, which arguably is the best way to differentiate, since there's probably nothing you sell that your competitors don't do. So you got to make it easy and a real pleasure to buy from you. And these tech experts are going to talk about ways of doing that. And then on March 13th, we'll have best practice study on the state of distributor technology, building your tech stack for success. Jonathan's really leading that. I'm just there for the eye candy. That's going to be brought to you by Epicor and White Cup. The Tech Elevates Customer Experience is brought to you by Esker, Epicor, ProKeep, and Continuum, which is a new company focusing on returns. So, wow, it's been a great show. Really, really enjoyed the interaction, and this will be, yeah, you'll get a link for the recording. Somebody's asking, so you will get that. So thanks to everyone for attending. Al, thanks for lending your superstar talent to this program. We really appreciate it. We'll see you on the next distribution strategy group event. And until then, be well and sell a lot of stuff. Bye now.